It's time now for an in-depth look at the global markets this afternoon, and for that I'm joined on the line by Dr. Hwang Seiwoon, Research Fellow at the Korea Capital Market Institute. Dr. Hwang, thanks for coming on today.
Nice to be with you today.
So here in Korea, as we just heard, the government expecting a growth rate for the local economy now of just 2.4 to 2.5%. It's that low mainly because of concerns abroad. Today, though, the government's announced some new measures to revive economic activity here. What do you see in those measures? And in the second half of the year, do you think they'll help bring around a rebound?
The government's latest estimate represents a drop from its previous forecast of between 2.6% and 2.7% in December. South Korea blamed the slowing exports and sluggish investment, as well as trade friction between the United States and China for its downward revision. South Korea's growth outlook could be lowered unless Parliament approves a 6.7 trillion won extra budget in July for a quick implementation. But it remains unclear when the National Assembly might vote on the bill due to a political standoff. Therefore, it is less likely for Korean economy to recover in the second half of 2019. Many of the market analysts are expecting that Korea will continue to experience declining economic growth due to its heavy reliance to export and the global economic slowdown caused by the trade dispute.
Yeah, well, speaking of that, this week after the G20, it seemed like there's been progress in the U.S.-China trade war. Wall Street's been setting new records, up again for a second day in a row on Tuesday. What's the story today?
U.S. stocks edged higher to a fresh record, while haven assets from treasuries to gold resumed rallies as investors awaited a slew of economic data around the 4th of July holiday. The S&P 500 swung between gains and losses before rising into the close for a second straight all-time high. Asian shares were subdued on Wednesday as initial enthusiasm over the latest U.S.-China trade truce was overtaken by fresh concerns over Washington's threat of tariffs on additional European goods. Global growth concerns also weighed on investors' confidence, with South Korea, the latest trade-reliant economy, to cut its economic growth and export targets a day after weaker factory readings worldwide. Japan's Nikkei dropped 0.53%, while Shanghai Composite lost 1.11%. South Korea's KOSPI fell 1.23% as of close today.
You mentioned the possible new measures against European goods. The U.S. Trade Representative has started the public hearing process to put tariffs on $4 billion of goods from Europe in retaliation for what it sees as the EU's unfair subsidies for Airbus. Do you think the U.S. will actually go ahead with these tariffs? And what's the view out there in the market?
The U.S. government on Monday threatened to impose tariffs on $4 billion of additional European Union goods in a long-running dispute over aircraft subsidies. The U.S. Trade Representative's office released a list of products that could be hit with new levies in addition to those introduced in April. This brings the running total of imports subject to potential levies to about $25 billion and offers a reminder that Trump's trade war has no practical end in sight. The EU said it remained open to negotiations provided these are without preconditions and aim at a fair outcome, but added it was also preparing to retaliate as soon as the WTO arbitrator had ruled on its right to do so. Washington signaled its openness last month to working on an enforceable mechanism to govern government subsidies for aircraft production, potentially resolving the dispute. The possibility that the U.S. will actually impose tariffs is not that high because it will be quite burdensome even for the United States to have two battlefields both in Asia and Europe.
Right. Then again, the U.S. has always said it's prepared for a two-front war. But all right, Dr. Hwang, that's where we'll have to leave it today. Thanks so much for coming on.
Thank you very much.